The prospect of higher interest rates in the United States continue to loom large over the markets, and recent inflation data may do little to change that sentiment. My next guest says one thing is for certain, that the U.S. is in the late stage of the economic cycle, suggesting there is downside risk on the horizon. We're joined now by Brad Simpson, Chief Wealth Strategist at TD Wealth. Lovely to have you here.
Well, thanks for having me.
So, I guess let me start this way. As we enter the end of February, what's surprised you so far about 2023?
Boy, where do you want to start? There's been a lot.
About the markets.
About the markets. Just keep it on the market. Okay. I think unequivocally that a minor surprise, just how well fixed income and equity markets have. But I started with the minor. The second part of that is that if I broke that down, equity markets started to rally in October of 22. Mm-hmm. I don't find that all that surprising. It'd been a really you're going to get kind of a blow off but what's happened in January and the sort of the rally that we've gone through and what has been rallying, that I find really surprising. And I don't think I'm alone in that. But that when you look at the environment that we're in, and we published our portfolio strategy quarterly in January, and it was called Right Here, Right Now. And really what we meant by that is that the market and the world that we're living in, we're going to see some real extreme times of negativity and extreme periods of optimism, and both of them are going to be quite fictional, right? And as we moved into January, fixed income markets were trading on fact. Late stage economy, interest rates starting to move down a little bit, obviously concern about inflation and a recession down the road. Equity markets went to fiction. And that's what surprised me. So I think we have a chart here that kind of hits that home.
We have two charts.
Oh, right.
Yes, let's bring it up. So this is I think you've got a chart here looking at the laggards for 22, which powered ahead in 23.
Right. So, all we're showing here is what we said, okay, let's look at the performance for this year and say, well, the thing that performed the least well was the things that performed really well in 2022. And what performed well in 2022? Companies with good balance sheets, good business plans, great earnings per share prospects down the road, kind of late stage, defensive. That was really what was moving the market. What was going down, and in many ways, you're leveraged, really no earnings, or if you did, your earnings were a long way away, or you were really paying up for them. These names went down in 2022, 50 to 70%. This year, they're up 15.3%. The ones that were the leaders last year, they're up 1.3%, roughly, in there. In our quarterly, we said, here's the things that we think you need to be concerned about, and that would be growth, inflation, recession, what's going to happen with interest rates, what's going to happen geopolitically. You kind of go check. Any of those concerns, they're no different now than right. And so, but what the process that the market went through, October it started out, okay, what if it's not a hard landing? What is a soft landing? And I love this. I wish we could get right. And then that's when we moved into the fictional world. Wait a minute, we can have a no landing. Yeah. How good would that be? Yeah. And so the extent of that, I know we've talked about this in the past, and I've written about this an awful lot. I think that quantitative trading kicks in, and we start cycling through what we think a business cycle could look like, but it could go through it in a week. I think that the force of that, of what we saw, and how quickly it turned to that, I find that surprising, and I think investors need to step back and think about that a little bit.
I want to bring up the second chart that you brought too, because you got to look here at, I think, drivers of total returns. One thing I'm amazed at is I think that the impatience of the market, like you talk about these fictional, it's because, cycles take time.
Right.
Social media does not have time for that. And so that's made the disconnect sometimes.
I think there was a survey in our elevator at my office where,
Very scientific, yes.
where where you get your news at TikTok.
Yeah.
It's pretty quick, is all I'm saying.
Yes.
And so what we're showing here is of course, is the reminders we like to think about is why we're talking about right here, right now, is because of these extremes if we get into. I wanted to kind of people to be mindful of that when you're allocating, if you're allocating to equity markets, you're thinking about ultimately earnings per share growth. That's where the total return comes from. This PE stuff and, rates will go back down so I'll pay up for things. That stuff doesn't carry returns over a long term.
Yeah. And earnings
right.
are coming down right now.
That's the irony, right? Is the rate and earnings are coming down. And if you started to want to put valuations on this, you can kind of look at a scenario analysis for equity markets, and you could kind of go, your best case scenario is around 4,200 for the S&P. We're kind of there. Your base case scenario is probably around 3,600, which is with earnings coming down and kind of adjust for that. That would seem to be a meaningful place. And your worst case would be somewhere around 3,200. You can't draw a lot of a scenario that would say that 4,200 for the S&P 500 makes a lot of sense.
Let's talk a bit about, you have been talking to us about making a case for bonds.
Sure. Okay. And first, for the equity market, when we're saying things like that, like we are underweight equity markets, but we think there's lots of great opportunities out there to be able to invest in. And really, what we're saying is that, but you got to go where the businesses are and where you're going to make money when you're in a late stage. Yeah. And so you have this noise around that, and then the underweight just kind of tells you the story if we're cautious. And so there's different strategies and hedging strategies you can do in that, and we think that being allocated there makes a lot of sense. What surprised me, and then on the fixed income and being allocating there, is, quite frankly, is just the mass movement into term deposits, GICs.
Yeah.
Now, I understand moving in because the yield is high, and we've seen yields in term deposits that we haven't seen in a decade, and so that makes a lot of sense to me. But the challenge investors have is they don't understand how fixed income markets work, and they kind of seem difficult, right? But at the end of the day, you can build an investment portfolio using bonds that have that same sort of yield to it, but with a lot of other attractive benefits that give an investor a lot better opportunities than that.
Like what?
Well, the starting point is that that if I'm going to buy a term deposit, I'm purchasing that because I know when I purchased it, what interest rate I'm going to get, when the maturity is. I can go out and I can buy a traded bond and do the exact same thing. Now, when interest rates go up, value of bonds go down. That's what we saw last year. Bonds, if I want to buy a bond that is trading below its issue value, par, they all mature at $100, right? So when it matures, no matter what, it's going to mature at 100. So if you go out today, there's lots of bonds you can buy below par, like $92, $93, $94 that are going to mature at 100. That move to maturity, that's a capital gain.
Yes.
Right?
Which does not happen in GICs.
Which does not happen in GICs. Yeah. The other side of the coin is that if interest rates go the wrong way, let's say they start going up, and you say, I'm going to lose on my bond. Not so. If you own it directly, matures at par, and you get your money back. Right? So that has a benefit into itself, the capital gain part and the taxation. And the fact is that liquidity, if you've got to get your money out of a GIC, I mean, you can if you really want to push it, but then you have to bust your way out of it, and then the person who's going to pay for it, you're really going to pay for that. Right? It's not going to be advantageous to you. That's not how fixed income markets work. It's liquid. You can get in and out of it a lot easier.
It is easy. It is liquid. It's the biggest market in the world. So there's that. But also, they're not quite as easy, I'd say, to trade for the retail investor as equities are.
No.
That's part of the problem. So how does somebody think about it? I mean, one way, they can talk to an advisor, and advisors can manage it for you. Other ways, but what are some other ways?
Well, I mean, that it's difficult. It's just flat out is. It's difficult. It's difficult to gain access to that, and I mean, you can, and there are some direct ways to do it, but it's not as simple as just going out and making a call and saying I want to buy an equity. Yeah. But nonetheless, I think it's. I mean, we're spending a lot of work on doing this because I mean, when I was starting my career in the early 1990s, I mean, this was a lot of how you built your fixed income portfolio. It was, you know, kind of laddering things up 1 through 5 to 6 years in corporate bonds, trading at a discount. You knew if interest rate went down more, you'd get a capital gain. If you knew they went up, you could hold it to par, and then you could sell it and get it back again. And you could kind of go through this cycle of doing that. It has a lot of that feel here to that today. And so, you know, that we are overweight fixed income, and we're overweight fixed income for a reason. We think that ultimately, look, interest rates are going to likely stay where they are and trades within a range bound here, let's say for the next year. And when we saw the 10-year U.S. Treasury move 50 basis points yesterday, that's a lifetime move.
Yeah.
Right? So we're going to continue to see that sort of volatility in bond markets. We're going to continue to see that sort of volatility in equity markets. But the 12 to 18 months out, you're likely going to start seeing a cycle where interest rates have a trend of moving downwards. If you're wrong, you own the bond, it gets maturity, you have your money, out you go.
Yeah.
If you're right, you have a capital gain, you have your interest that you made, you got your capital gains, you got the tax implications with it, and those, what we like to say, you know, optionality, those different benefits or features of it make that a much more attractive investment than I think and I think you just got to do a little bit more digging and work.
And I guess the risk to this as well too is if rates continue to rise.
Yeah.
But I if for people who are play poker or things, you could even look at just kind of like the probabilities of this happening. We've got up high, but I mean, but rates could still go higher. I mean, that is something that happens.
There's two sides to look at that. So in this laddering that I'm talking about and buying them at a discount, if they do rise, it's not going to impact you.
Right.
Second one is that when you're doing investment, you're right, we're thinking about probable outcomes.
Yes.
And so when we're publishing an article tomorrow, really imaginative title. We got to get, we fired our creative team and we decided to call it Bonds versus GICs. And I know it's rivet, Jim, but at the end of the day, we actually walk through their scenarios where if interest rates go down, if interest rates go up, if credit spreads, if credit spreads widen, so what happens when they widen, that the price of the bond goes down because it seemed to be more risk in it.
Right.
We look at all those risks, almost every kind of risk scenario you can think of, and you kind of come to the go, yeah, but it matures at par, and you get, and so there's in many ways, there's a lot of structural reasons today why this is part of somebody's fixed income portfolio. And I remember when you're coming at it from my perspective, this is all about have an investment portfolio that is driven by a wealth plan, driven by your asset allocation, utilizing a philosophy for making decisions. And for us, this is part of that portfolio approach, which in our philosophy of doing things, which is based on adaptability, it makes a lot of sense in an environment like this.